Okay. Good evening. So it's kind of interesting. Last semester, I was the associate manager for energy. This semester, I'm the sector manager. So I'm glad to be back up here. It's a privilege. I see Barry and Nina are back. Enjoyed the questions, and I'm glad to be back and hear some more questions. So this semester, I'm actually just doing the introduction and coming back for the Q&A. These guys worked hard, giving them the opportunity to present. My name is Carlos Consuegra, sector manager. Brandon Rodriguez, the associate manager, and my analyst, David Emerson. So without further ado, let's have some fun.
Just a quick market outlook, since, of course, energy affects the market as a whole. So what we see here is in the past 20 years, up until 2000, oil prices have been trading at a steady price, but then started increasing around 2000, where it reached a peak in 2005. The peak in 2005 was due to speculation, as you all know, and then it dropped again in 2008 due to the financial crisis. And of course, since then, it was trading at an all-time high, around $95 to $100 for about 4 to 5 years. In addition to that, we've been in a bond bull buying market for the past 30 years, and interest rates have been at all-time low. And so the reason why this is important is because shale oil has been around for quite some time. However, the issue is that the break-even price was about $65. So at a time, a lot of companies could not do hydraulic fracking or horizontal drilling because of that. But now, with the oil prices at $95 and interest rates very low, they're able to increase their capital expenditure and tap into this oil. And so because of that, there's been issuing a lot of bonds since 2005 in order to raise capital and increase this production. Furthermore, at the same time, we've seen that the European Union has been issuing a quantitative easing program. And so because of this, they've had negative interest rates. And these negative interest rates has caused an influx of investments into the United States, which has caused the dollar to appreciate nearly 14% since year to date. Now, commodity prices are inversely related to the dollar. So of course, with the dollar going up, you're going to see commodity prices going down. Of course, you see here now oil to natural gas. Natural gas hit 2 peaks and has now been leveled off, trading around between $2 to $6. The reason for this is because of the shale boom in natural gas and in oil, and also because the amount of supply that's there and the demand that's not needed. So we thought that due to last Christmas's winter, since natural gas does trade seasonally, we were going to have the same demand as well. But since the temperatures weren't as cold, the demand wasn't there, so we have a huge oversupply. In addition, the same thing with oil. Due to shale revolution, we've had so much oil in the market and continuous production by OPEC. And we believe that oil is going to continue to trade between $40 and $70, just the way natural gas is going to trade between $2 and $6. And the reason why is, like I said, from OPEC, they've continued to announce back in November that they're going to continue production. But furthermore, the reason why they have to continue production is because they lost 50% of the U.S. customer base due to the shale revolution. As you can see also on the right-hand side, they have to balance their budget with the oil. So even though the break-even price for OPEC oil is about $25, they have to balance their budget and they need oil to be up at $90. So of course they're going to continue production. Furthermore, if you've been reading the news, Iran is currently about to have their nuclear program pass, expectedly June 30th. They have about 30 million in capacity that they can release if they have their oil programs come back online, as well as 700,000 barrels per day as early as 2016. So this is going to keep oil prices even lower. In addition, if you look globally, China has projected for this coming year 7% growth rate, which is much lower than before. And also, as well, the United States posted a very slowdown in quarter one for 2015. So this is going to keep oil prices even lower. And of course, natural gas is going to continue to stay low due to supply being there's too much supply in the market. So taking this into consideration to do our top-down analysis, we realized that with oil prices being extremely low, we knew that exploration and production companies are going to be significantly hurt by this. Like I said earlier, the shale price is $65, so of course now trading around $60 is not going to help them as well. So we decided to eliminate exploration and production from our analysis. Since these E&P companies have cut back on capital expenditure about 20% for the fiscal year 2015, of course oil and gas services are going to suffer because of this. Now, when we looked at chemicals, we figured that chemicals would be too much to the industrials, so we decided not to look into it. And that left us with midstream and refining. However, when we looked into refining, the issue is that they've been up 35% for this year, for 2015. So we decided that we're too late into the game to get into refining, so we cut that out. That left us with midstream companies. Most midstream companies are your storage and transportation, so they make money all based upon fees. So pipelines that run all the way to the actual rigs, they make fees off that. Loading onto barges, loading off of barges, they make fees on that. Again, right now with inventory going up, all that storage, they make fees on those storage as well. So it's really a great time with commodity prices being very low. They're not necessarily affected by commodity prices, so this is really good for them. Now looking at an industry outlook for storage and transportation, as you can see, both the energy index for S&P 500 and the storage and transportation index were at their all-time high when oil was about $105 back in September, August. Now, of course, oil is at its lowest point, about $57 as of last Thursday. Now, if you can't really see it here, but the energy index has dropped 17% because of the oil prices dropping 50%. However, the storage and transportation has only dropped about 6%. So again, commodity prices aren't a direct influence for storage and transportation companies. Their key drivers are all based upon volume, and that's all based upon demand in the local area. Storage as well, since we see inventories going up, there's a more need for storage, so they're making money off of all these storage fees. Of course, they have a lot of debt because they have pipelines, transportation terminals as well. So interest rates do play into effect. However, interest rates have been low for most of the time, and because of the recent economic outlook, it looks like the Federal Reserve, we believe, is not going to issue as fast as they said they would. And then you have the Federal Energy Regulations Committee, FERC. All spot rates have to be filed with them before they can charge their customers. And they also have a heavy influence on what goes on in this industry. Some catalysts have been petrochemicals, and that's all based upon local demand. The shale revolution as well. So because of the increase in output, there's been more volume through storage and transportation pipelines, and they're making fees off this. And then potential exports as well is another factor. So to talk about our company this evening, I'm going to introduce our Associate Manager, Brandon Rodriguez.
Thank you, David. So the company we're pitching is Enterprise Product Partners. This is an MLP in the midstream sector. And before I really go in-depth into Enterprise Product Partners, I just want to go a little more in-depth into midstream that David was talking about. So midstream companies, they're not like upstream companies or downstream companies that rely heavily on commodity prices. Because it's a midstream company, they are just the storage and transportation, so they act as a middleman, if you want to say, from the drillers or the integrated companies such as Exxon and Chevron to the downstream, such as Valero or other gas sellers. So here we have the basic structure. So the general partner owns 35.6%. And that's just reflective of the confidence and the strong ownership that the limited partner has in the company. And I should mention that as an MLP, there are no IDRs, so there is no additional withholding from the distributions. So here's some quick highlights about Enterprise Product Partners. So again, they are a midstream company. They operate in crude oil, transportation storage, liquefied natural gas and natural gas liquids, and a lot of other hydrocarbon byproducts such as propane. So here we see their market cap, something to keep track of. This is a huge company in the midstream sector, one of the largest in the sector. They have a low cost of capital and they have strong financial flexibility thanks to their highly unlevered balance sheet. We also see their yield here, 4.49%, which is actually a sector leading yield, as well as their low beta. So again, to kind of reiterate, this is not an oil play. This is not a company that's going to that we're looking to rebound. We've seen it perform well in both environments of low oil prices and high oil prices, as well as other commodities. So here's a quick, map of all of EPD's assets. So the red circle up there, the reason why we have that's actually where 50% of all United States refining activity happens. And it also happens to be where EPD has most of their assets. And they also have 100% accessibility to ethane cracking through their strategic placing. And something I should mention while we're here, so EPD actually completed a recent acquisition of Oil Tanking Partners. It was a $6 billion transaction closed in February of this year. Why it's important? The completion of this transaction gave EPD, it made EPD the largest oil storage operator on the Gulf Coast. In addition, I'd like to also add that as of 2014, the United States became the largest exporter of propane. And why is that important? EPD is the largest exporter of propane from North America, waterborne. So here's a quick SWOT on the company. So I just want to talk again about some of the strengths of the company, which we'll get into the comparables and financials. But EPD has a highly unlevered balance sheet comparable to other companies. So David was mentioning earlier, interest rates. MLPs are very subject to interest rates, as well as, companies that work on fees. So the nice thing about EPD, 95.9% of their debt is fixed. And the average maturity of their debt is 13.7 years. So say interest rates go up, and which they will, and they will be gradually, EPD will probably see a very minute effect for some time. Something else I'd like to mention, so again, with their unlevered balance sheet, they have a significant amount of free cash flows. And in spite of their high CapEx that they've had recently, they've been able to maintain close to $4.6 billion in unlevered free cash flow at the end of 2014, allowing them to do all kinds of CapEx. So in opportunities, I mentioned consolidation of the sector. So the midstream sector is seeing a lot of consolidation because what happened was oil prices went down. We saw a lot of upstream or as well as integrated companies such as Exxon or BP starting to sell off their own storage and transportation units because integrated companies do have small units of their own storage. So because of this, because we see a lot of consolidation, we know that EPD has a great advantage because of its huge amount of cash flows in the sector as well as its light debt load relevant to its balance sheet. Something else that would be opportune for EPD would be increasing volume, which we see with increasing production. So really the only weaknesses we see to EPD are probably the modest distribution growth. But you have to understand this is a $68 billion company, and with a 4.49% yield, it's pretty modest. And it also, sorry, there's something I had to mention, but to continue, another thing to remember is that they also are significantly large, which I've been mentioning over and over again, but it's key to remember their unlevered free cash flows. So one of the weaknesses that I mentioned there, significant size restraining future growth. However, remember how much unlevered free cash flows they have. And remember, I should also mention their sustainable CapEx is only $380 million. So at the end of the year, they have a lot of room to do what they want in a sector that's been consolidating. And of course, the threats that we see are, trends in climate change as well as trends in the FERC, which regulate the fees that EPD imposes, as well as further depressed prices of hydrocarbons. But remember, again, this is a strictly fee-based, volume-dependent business. So let's go over some of the revenue segments. So we see their asset allocation largely consists of natural gas services, onshore pipelines and offshore services. It's approximately 66% of their current assets is natural gas devoted. So because natural gas has recently been seen increasing demand over the years in emerging markets, as well as seen as a more efficient alternative to coal, EPD has kind of put itself in that market. That market's going to develop, especially when natural gas is extremely cheap. And we also see that they have a significant amount, or at least a substantial amount, of crude oil services. And with their recent acquisition of oil tanking partners, it really puts them in the field for oil storage. So some quick charts to go over their financials. We've seen consistent operating margin growth. We've seen actually 42 consecutive quarters of increases in distributions. And coupled with the amount of distributed cash flows that I've mentioned, as well as their coverage ratio of 1.4, we know that this company has enough money to maintain their growth in an environment that requires a lot of high growth CapEx while maintaining a unlevered balance sheet. And here's some volumes and some important, obviously, for a volume-based business. So we see volumes increasing. That bottom left chart is what I was referring to about propane. So like I mentioned earlier, the United States did become the number one propane exporter in the world, and EPD is actually the number one from North American waterborne exports. And we've seen pipeline volumes increasing, which just means more revenue for EPD. Some quick ratios and margins to go over. So their debt structure, which is really the emphasis of this company. Remember, this isn't an oil play. This isn't a high-risk aggressor. This isn't something evident through their balance sheet that would pose risk. This is more of an income opportunity in an environment where people are looking for yield. And we see their low net debt to EBITDA. We see low debt to assets and EBITDA to interest expense. And again, with that, we still see consistent growth in their margins as well as earnings per share and dividends. So comparable. The main things that we need to take away from here are what reflect, again, the defensive structure and resilient structure of this company and its ability to thrive in an environment with consolidation and a tightening environment because of the commodity prices. So net debt to EBITDA we see at 4.37, evident, again, of their strong unlevered balance sheet. As well as another thing to mention, the sustainable growth. They were one of the only companies in their entire sector to have positive sustainable growth, meaning they could grow after paying off all their debts. And of course, your dividend yield is also higher in the sector. So when it came to our valuation, we assumed a modest growth of 1.5%, and via our EBITDA method, we came up with a price target of $40.23, suggesting an upside of 18.22%, as well as the perpetuity method that yielded a $41.27 price target. And in our football field analysis, we again see similar suggestion with a midpoint target of $39.24. So based on our own valuations, we obviously see a lot of upside potential in EPD. Through our EBITDA method, we see 24%. This is after including yield. We see 24% upside potential, perpetuity suggesting 31%, and our football field midpoint suggesting 20% return. And when we wanted to see what the street was saying, we actually found out that their estimates were in line with our estimates. 23 out of all 26 analysts currently covering the stock rate it as a buy, with a consensus target of $40.95. And with that, given EPD's strong management, its ability to execute excellent capex and maintain a lot of unlevered free cash flows, as well as its high distribution yield and high coverage ratio, we definitely recommend EPD as a strong buy. And I'd like to welcome my team back for questions and answers. Thank you. I should also mention the company is actually, it might be familiar because it's actually currently held by the board. We have only 3 shares, so this is definitely a safe play for the energy sector. But yes, come on.
So I'm a little concerned. The current yield, if I recall correctly, is 4.49. Dividend yield is 4.49 on the stock?
Yes.
And your price target assumes that the yield will be 4.21. So you're assuming that the market will accept a lower yield in order to hold this stock than it does today. That's also in an environment where I would think interest rates are going to be rising. What is your expectation for interest rates in general, and why do you think the market will accept a lower yield in an environment of rising interest rates?
Right. Carlos, you want to clarify about the yield?
Yeah, so the first thing I would add to that is just that the company is one of the largest midstream companies, 65 billion. So you get a premium for versus the comparables. And also, when we analyze the interest rate environment for the last 5-6 years, this is where 10-year has been trading. So it's in a range. Currently, we're looking at the range for the 10-year to stay in that range and even go lower. As David mentioned earlier, we have negative rates in Europe. We have QE in Japan. So everybody's being driven into U.S. assets. So we don't see how, as long as it stays below that the trend, this resistance lines, we don't see any issue with it.
I would also like to mention again. So with the yield, obviously a company of this size needs a lot of growth capex to maintain that type of growth in their distributions. And the reason why we would imagine that over the future distribution yields would be increasing is because they have the large amount of unlevered cash flows as well as their unlevered balance sheet, relatively unlevered balance sheet. So I mentioned earlier, their debt load is immensely fixed. So interest rates go up, it's going to take a light toll on EPD, if anything, light to minimal. Yes.
So I think they're distributing a lot of their cash flow after the debt service. Is that right?
Yes.
So I think that would be the question: is what puts the earnings capability of it at risk, such that if that's the case, if that was to drop for some reason, I think a slowing economy would be the big risk. You have less volume, and then it's going to the distribution shrink as the earnings shrink.
Right. Well, I mean, theoretically, yes, but I do want to mention, so the earnings call for this company, the earnings actually came out for this company today, the Q1 2015. So the company actually saw 41% decrease in revenues. So that's obviously, an eyebrow raiser. However, you see a 44% decrease in OPEX, and we see a 4% increase in, that means an increase in operating margin. We saw a 4% increase in distributable cash flows. So in spite of the environment, the company has still been able to I guess, cut their expenses, although decrease revenue, of course. And again, just thrive in both environments.
I've got a question. What terms do they sell under or collect under? Is it all cash, or do they give credit terms?
I mean, I would assume that they give cash and credit terms, but something else to mention, with a lot of their producers that they might go into joint venture with or that they might make contractual agreements with, they usually agree to minimum volume. So this company actually this morning, alongside their earnings report, announced a joint venture with Occidental Petroleum in the Delaware Basin. And EPD and Occidental will control that production facility, and EPD will require 10% minimum volume from Occidental, so at the very least. So there's, of course, volume minimums as well as different types of fees.
So you scared me a little bit with that comment that revenues were down 40% for the quarter today.
Year over year.
But you said they were able to make it up by cutting expenses by 40%.
Yes, expenses are down 44%.
I mean, you can't keep cutting expenses. This should be a fixed cost business, right? Operating, pipelines every quarter by 40%. I can see how, revenue goes down.
Mm-hmm.
But why do you have comfort that they can keep up with revenue declines like that, in longer term?
Right. So again, in this type of environment, it obviously, depends on how much money the company would have to be able to put towards CapEx. And again, something that we want to stress is this company has acted resilient. Its balance sheet is impressively resilient. And because of their significant amount of cash flows, even after the $6 billion acquisition of oil tanking, they would only maintain cash flows in order, if they need to, launch a new project or do this to increase their yields. Yeah,
so I just wanted to add to that. The sustaining maintenance capex is only $380 million projected for this year, whereas their free cash flows is supposed to be a little under $4 billion.
Yeah, I have one more question. So, did you guys get on that conference call? Were they saying on a going forward basis what's going to happen with the revenue and what's the plan?
I mean, specifically about where they see revenue going, again, that wasn't so much of a concern because, again, since it is a fee-based business, as long as you see volume keeping up or a stable amount of volume, you have revenue coming in. And the reason why you saw the large drop in revenue, is because of the lowered prices affecting integrated companies and upstream companies. But the outlook was positive. The stock opened higher today. I guess the market loved it. So, do you want to add about the outlook?
Yeah. So, considering oil tanking, they just did that acquisition. So they're getting more ability to export all the byproducts because we can't export crude. So we can export the byproducts, propane, ethane. So that was part of the strategic acquirement of the company, where now they can go and manage, sell the products outside the U.S. Because, as you can see here, as Brandon mentioned, natural gas prices are the lowest from $2 to $6 range, right? So everywhere else outside the U.S., natural gas prices are very expensive versus us. So it makes sense if we have a cheap cost to actually export where there's demand for it, just relative, just collecting the spread on that.
Elaborate, if they have such flexibility in cutting costs, basically the assets which they employ are perhaps third-party assets? I mean, how can they shrink? How can they have such flexibility in cutting expenses, and yet the market seems to indicate a confidence? So basically, they're a true intermediary. They don't necessarily own everything they employ. Am I correct?
They have affiliates where they have joint ventures, but that's not the biggest part of their earnings. I'm trying to remember the exact number, but it's very small. Most of it they own completely. Again, it's you have free cash flow, the maintenance capex, and then you can put that to pay down debt. Their interest payments are we modeled out just $1 billion. $1 billion a year. But after that, it's just covering the distribution and maintaining some more for reinvest growth capex, which they have for the next two 2.5 years, it's estimated to be 6.5 billion.
Distribution is about 3, right?
Yes, it's between 2 and 3 billion.
Why do you think there's growth when the PE was looked like a little high, was like the 24s?
So yes, the PE going forward did obviously seem higher. This number actually here is correct, but so if we go back to the first profile, we see a PE of 22. However, when we go to the comparables, we see that relative to the sector, it's actually a conservative indicator. Again, relative of their stance as a resilient company in the midstream sector.
Yeah, versus the sector, comparables, it actually is lower than the narrow and the wide, but it's also MLP. I don't put too much emphasis on the PE. It's mostly for the distribution, free cash flows, and how many times they can cover that distribution and reinvest into the company. Because it's a fee-based business, the only way you're going to grow is by acquiring assets or expanding the pipelines you have in the storage.
And this is one company, again, that, in spite of the capex that it's spent in the past, has been able to thrive in synthetic growth as well as natural growth.
No questions? We need to move on, and then I'm going to have a coffee question for you. So, all right. So, all those in favor of having this?
Question, Flavio.
Oh, sorry. Go ahead, James.
I'm a little lost as to do you have a number of companies that you typically vote in? Do you want us to?
No.
Is
you
it
vote for
what?
each one of them. That's
Okay.
fine. Your own money.
Yeah, that's the key part.
You leave your American Express gold there at the end. No, you can. Right, the process is you can actually vote for. I mean, last semester every company got voted in, so that doesn't matter. That's part of the portfolio. So let's go ahead and vote. On this one as well. So how many in favor of this company? Please raise your hands. Not too many takers. All right, that's fine. Thank you so much.
Thank you.
Financials.
Gonna do a coffee break?
Okay, so yes, I wanted to ask. I want the students to remain seated. This is not a break for you, but I do want to tell the board that we do have coffee outside. So if you could just grab the coffee and come right back in if you want coffee, that would be great. Afterwards.
So can I use the mic?
Yes, you can. Yes, you can. Yes, you can. Can you move to the side a little bit for a second? All right, class, Professor Dagler wants to address you for a second during this break. So,
for those of you going to be here in the fall, either undergraduate or graduate, a course that's not typically offered, I'm going to offer the financial software course, undergraduate or graduate as independent study. So there's a couple of components briefly. One is financial software. You say, well, I know Excel. Do you know all the aspects of Excel, including data tables and pivot tables and different functions? The simulation, crystal ball simulation program, which is often used in retirement. And Bloomberg, now many of you probably have Bloomberg certification, which you and I know you can get just by cheating. But we're going to actually work like some of you have, much more deeper in how you use Bloomberg. The other aspect of the course is trading, and I don't understand why anybody can get out of finance without knowing something about trading. And we're going to be using, I think, the best platform of Thinkorswim. Very complicated, but useful to use. have a trading game throughout the semester of trading different assets and learning how these markets work. And then the Rotman simulator where you all trade against one another to see how markets work. So if you're interested, sign up.